I'm doing well. Got a question for you. Two questions, if I could.
Sure.
Fairly new to the trading futures, and on the one, when I look at natural gas, I'm thinking about retaking a long position on the UNG, and I've been looking at the natural gas contracts as a way to kind of trigger my buy time, my buy signal. And depending on what contract I look at, meaning either the March or the April contract, they're kind of showing different things. The March contract shows that it hasn't quite gone past the breakout level, but the June or the April contract does. And the reason why I'm thinking about doing it as buying it off of that is when I look at the UNG, it looks like, coming off, might be doing a 1.618 expansion from the A point being February 1st, the B point being February 17th. It looks to be like a 1.618, kind of blew past it a little bit today on the gap down. There's another, A to B on a 1.618 expansion on a larger one, with the A point being January 19th, B point being the January 30th, and it looks like that 1.618 expansion would take it on at like 1774. So my question is do I look at the March contract or look at the April contract? What should I do, Larry?
Well, I think you're trying to compare apples and oranges here, because the UNG is basically an ETF for natural gas stocks. So you want to just trade that. I mean, you can use the natural gas, as a guideline if you like, but I wouldn't be looking at the UNG until it gets down into that the low 1700 range. I put into Tiger TV the big butterfly that's out there, going back from late January, and that has a range of we're in the range right now from around 1800 to about 1800, around from $18 a share to $17 a share, on that. But the actual natural gas, will measure, a lot lower than that. Now, when you ask to compare March to April, you really shouldn't be looking at March, because you're into delivery now. They don't deliver anymore. But what happens is that people don't trade it. They roll the contracts over from March to April, just like they do with the gold and the S&P and all the others. So you really should be looking at April when you're looking at the natural gas contract.
When you say rollover, does that mean physically closing out the March contract and purchasing the April contract?
Yes. That's exactly right. As the less traders come in to trade, there's no pits anymore, but as less traders are trading, the margin will go up on the less liquid, which would be the March. And so people don't like to pay extra margin, and they like good liquidity. And so as the contracts come out of March, in other words, the buyers and sellers, even out, they roll their positions over into April or the June contracts, and then you start having more liquidity. So you always want to, like when you're in March, you always want to look at the April or May or June, what happens to be. Like it's happening right now in the S&P. We're rolling over from March into the June contract. The same thing with the NASDAQ, and with Treasury bonds, we've already moved from March to the June. So that's just a function of the futures, the markets. I try to cover that on the Thursday Commodity Show, and I will bring it up again. But that's really one you want to look at, is the April. The March really has no significance anymore.
Okay, that's what I was figuring as much. I was looking at the April contract, and that's what also made me think that possibly. And thank you for correcting me on the UNG on the apples oranges comparison, because the other thing I was looking at is they're different. That's all. It's I don't do anything in UNG, so they are different. That's the main thing that you want to keep in mind. Well, along those lines, could I just ask you to take a look at the April contract for natural gas? Because it looks like it's done a 1.618 also.
Well, I will tell you this. I'm going to have to double-check this, because someone just corrected me. They just said that the UNG is really not an ETF for stocks. It actually holds contracts of the natural gas. And I don't know why that would be, because it wouldn't be priced in per share, but I will double-check this. I don't like the, I'm not really an ETF fan, but, some of them are pretty good, like gold and diamonds and things like that. But I will double-check that, and it looks like I'm probably wrong on that. And if that's the case, you really have to wait till it gets down into that low 1700 level, $17 a share. That's what I would do, because it's really clear that the natural gas wants to go to that that 228 level, and at least touch that new bottom again. And that's going to make another 21-year low. So we'll see if that's going to be a double bottom. But right now, I wouldn't touch it.
Well, that's what I'm kind of glad to hear you say, Larry, because when I checked out UNG, I take Tom's market insights, and he's the one that kind of put me on the UNG. Had a trade earlier in the year we had a nice little profit on. And then I was thinking, so when I was kind of investigating it myself, I was thinking that it was traded off of, natural gas contracts. But I also know that you have forgotten more than I've ever learned when it comes to trading.
Yeah.
So I want to defer to you. But along those lines, if and I don't want to take up too much time here, I don't want to overstay my welcome. But looking at the April natural gas contract, it looks like it's hitting that 228 earlier today that you were talking about, and it looks like also you have the B to a C leg, or C to D rather, leg that was 1.618, the expansion of the A to B, and the A being February 2nd, and the B point being February 17th. And it looks like that's a 1.618 that expansion, so maybe possibly might be time to long the April contract, or do you disagree from what you said a second ago?
Well, I still think it's got a chance. I've looked at this, and I was going to cover it the last part of the show, but I'll cover it while we're going through right now. So if you'll bear with me just a second,
sure.
I will get the futures out for the natural gas, and we'll take a look at that, because I know we've talked about this before, and whenever we get down into these levels, people are always interested in what we're looking at. But frankly, we are really near the double bottom of the the February 23rd level in the natural gas futures, down around 2.31 cubic feet. And
right.
I believe that this is probably, we're going to go a little bit lower. It looks like we're going to go down to that, maybe even to the 210 level, and that would be making a new bottom. Now, we're either going to make a double bottom here at the 223, 225 level, or we're going to go lower. So right now, I couldn't touch this stuff here. I mean, I thought it was a good buy at 245. And, we gapped down on Monday, and, frankly, I wouldn't touch it again until, I get a little more information. That's the way I would look at it.
Okay. Well, thank you very much, Larry. I greatly appreciate you taking my call.
It's my pleasure, David, anytime, and I hope I haven't confused everybody on the UNG, and it looks like it is a thing of gaps, because not of gaps. It's a contract for the actual natural gas contracts. At least it looks much better than most of the ETFs that that are actually out there. So, I'll keep that in mind when I.
I'm sorry, Larry. I didn't interrupt you. Just, if I could, quick question because I'm watching you on Tiger TV. The contract that you've got up on Tiger TV, what contract is that? Is that the April, or is that?
That should be the April. Now that should roll over. Now I'm not in the natural gas, and so I'm not actually sure which one it is. But because of the quote system that I use two different quote systems. I use Commodity Quote Graphics for our platform trading for the hedge fund. And then for my charts, I use eSignal, which is the Ensign, charting package. And when you see that pound F, that means current active contract month. In other words, they'll be switching over to the from the March to the April. That should already be switched, because you're in the second. You're in the second week of April today. No, this is still the first week. It's marginal here, whether it could be the March or the April. It should be the April.
Well, I think you're looking at the March, because I pulled it up, and while you were talking, and I saw that, I pulled up the March through Thinkorswim, and the March as well as the April. And the April is blown past the January 23rd low. But in any event, I guess we'll take a look and see what happens.
Well, on tomorrow's show, I will get this whole thing straightened out on the natural gas, because I will look into it a little bit more, make sure that the April is the one that I'm looking at, and bring it out. But frankly, I wouldn't touch it yet. It's really not a spot where I'd want to be looking at it.
Okay. Well, thank you so much, Larry. I greatly appreciate you taking my call.
No, it's my pleasure, and I hope I haven't confused everyone. And so I will cover it tomorrow on the commodity show to make sure that we do get it right, because markets that are making 21-year lows like this one is usually have a place to, get ready to turn around eventually at some time. In fact, this is what we're looking at in bonds, but, that hasn't happened yet either. So thanks for calling in, David. I appreciate it.
Thanks, Larry. Have a great day, sir.
Okay. I want to get back to the part that we were talking about, and that is the gap that we've had in the New York Stock Exchange Index. And, we're having a little bit of a bounce today. And if you'll have a chance to, to go into Tiger TV, you'll get an idea of, the severity of this gap. I mean, to realize, folks, that, for the New York Stock Exchange Index to gap down as much as it did yesterday takes a lot of selling. Even though the volume isn't very much, it takes a lot of selling. And so as we come into this gap, it's going to be, a place to offer resistance. And if you take a look at, the 30-minute chart on the New York Stock Exchange Index, this is the one that we posted Friday that we talked about quite a bit, where we were making that AB equals CD pattern up near the top on last Friday, and the fact that we had a three-drive pattern occurring at that time. And, we felt that could be, something, rather ominous. So far the market came down, but it didn't come down that much. But what we really need to do, and we're probably going to have to do it after the break, is I want to review, what's happened on a global basis to everything that has occurred, over the last, 36 hours, because we've had a great things happen. And so we'll take a look at that after we have a break here.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you seek to maximize your returns. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of The Money Game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, we're back. If you have any questions, it's 877-927-6648. And, since last week, the market had been up all the time. We finally had not all the time, but on the last 47 days, we hadn't had a 1% correction in the S&P, and we've now had that. That's the first time we've gone 47 days without a 1% correction since 1995, so that means a great deal. The thing that we've been talking about here over the last, at least since January 23rd to January 30th, is the fact that all of these global markets, Asia, London, Singapore, everything was actually making these huge AB equals CD patterns. We had it in the DAX, the FTSE, just about everything, and all across the U.S. indices, of course, and it was, really quite amazing. In addition to that, we had the VIX index, that actually has been, down to near levels that it hadn't seen in years, and, the breadth of the market, we've talked about the fact that the new highs to new lows has looked absolutely horrible. The volume is really pathetic all across the stock market, and these are things that you usually have various implications. Now, the fact that we came down hard one day really doesn't mean very much. The fact that there's a gap there does mean a lot, because you don't see a gap that large on the New York Stock Exchange Index, very much. And so what we're looking at is to see what happens, with the market if it goes in to try to fill this gap, and if it gets in and it fills the gap very quickly, like Basil said, this thing could just be a 1 or 2 day correction. And, we're going to go up and we're going to break all these patterns, to the upside. And frankly, if we take out these highs that we've made over the last, 3 or 4 days up around that 1380 in the S&P, if we take those out, then that is going to tell the technicians that this thing looks like it's going to, take off and go a lot higher. But that's a long way for that to happen. And so what we want to do is prepare, if this in fact is the move to the downside that we're looking at. And there's a potential that it could be a quite ominous move to the downside for all these reasons, that we've talked about, because of the fact that, we are into this area where all of these patterns have completed, and, the whole world is, and I don't mean the whole world, but, the bulk of the world is still, very complacent about what's happening, with the stock markets of the world. I mean, I saw a chart today on Bloomberg real early this morning that I couldn't believe, and that is the fact that the Italian 2-year notes have gone to 2%. I mean, Italian debt is really not too good, and as far as on a relative basis, and yet over the last several months, the rates on the bonds have actually dropped a lot, and those are 2-year notes. Excuse me, not long term, but 2-year notes. And so it's telling you that people have a great appetite for debt. And my whole premise of this, this cycle, that it broke way back in 2007, that this is a debt cycle, and this is where the problem is going to come down the road, is the fact when people go, to try to redeem this debt, that they think that it's going to be good, and in fact it's not. We're already seeing that in Greece, where they have 38%, rates of return on their bonds, and I frankly don't think anybody should actually look at that. Now, I need to switch over to the gold market, because we've had a really big correction of over $100 an ounce, and then we've held it. We're coming down, and we did some testing of it yesterday, and the market's bouncing back a little bit today. But the interesting point is that this gold and silver index that we've been watching over the past weeks has made those bearish Gartleys to the downside. And when you have this occurring, you're really looking at a potential buy signal in gold down here if it can hold this level. And this is why we're looking at it on a daily basis, that the gold and silver index hold this 184 level, the level we made yesterday, because if it can do that, it has a chance to go a little bit higher. Okay, we've got a call from Mike in Florida. Are you there, Mike?
Yes. Hi, good morning, Larry. Thanks again for everything you do. Good, very good. I know you probably have looked at this half a dozen times anyways, probably in just the last day, but I'm just curious, like on the YM, which is the Dow, and the ES, on a monthly chart, could a case be made that we have bearish Gartleys from the high of 2008 down to the lows of March 09? And I'd let you just take a peek at that. Could a case be made that we have a huge monthly bearish Gartley pattern?
Well, I believe that is what happened. As a matter of fact, I think in the newsletter that I did 2 weeks ago, I believe, I focused on the really long-term. I'd have to go back and double-check that, but okay. I focused on the really long-term, patterns that were there, because they were, in fact, going back, I believe, to the all-time high that we made in October of 07, and it shows that those retracements, especially the new...
Hi, folks. This is Tom O'Brien. If you want to get great trade setups in equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com, under newsletter, hit the Market Insight tab for your 2-week free test drive right here, right now.
In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices, along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back. 877-927-6648. Mike, are you still there? Oh, looked like we lost him. Anyway.
No, I'm here. I'm here, Larry.
Oh, great. I put into Tiger TV, I found the monthly chart for that I put in the newsletter a couple weeks ago, and it shows, the lower highs. Now, it's not a perfect Gartley pattern, but, it's up against the 786. But the Dow is really a very poor indicator, of what's really happening. You've got a stock in there like IBM and Caterpillar and stuff that are very heavily cap weighted.
They all look the same, though. Like the ES looks ES, the Russell, they all look very much like that, too, though.
Well, actually, I also posted the long-term monthly for the S&P, and it is, it is not broken above the 786 level, whereas the Dow has done it by about 100 Dow points. And the New York Stock Exchange Index, the one that I really, follow as far as what the overall market is doing, has just barely made the 786 on the daily. It hasn't even come close to it, on the long-term monthly. So overall, it, doesn't have that same, look like the Dow does. But you're correct. You can say that those are, making, Gartley-type patterns. They're not as symmetrical as we like to see, especially in the Dow. But in the S&P and the New York Stock Exchange Index, they certainly are. And then with the, of course, with the NASDAQ, you have a butterfly pattern forming because, the divergence there is greater now than it was in, 2007 when the market was topping. And I also showed that relationship that when we have the divergence of the NASDAQ going crazy to the upside and the rest of the market not following, it's been a precursor of the market, falling. Now, we only have three examples, 2000, 2007, and now. And so this is, this is where we are now. So this is why I think we have to be extremely careful.
When these bearish Gartleys confirm to you and you say that we're underway, do you project that they will take out the down to the 8 point? Are they that strong?
Oh. I can't do that. No, I don't know.
No,
I mean, no one really knows what's going to happen. My first thing is try not to lose very much, and so what I do is see how much I have to risk, and then if it starts to work, and this is why it's such an important time today, is we had this big gap down in the New York Stock Exchange Index, and if that gap isn't filled, and we only have, today, tomorrow, and, Friday to try to fill it, because if we come in over the weekend and the market gaps down again, that's going to tell us that, we've got trouble in River City big time. Because in 2007, the market just gave everybody the chance to buy it all the way down, and I don't know if it's going to be the same type of setup, but, we are really over a bearish time, in my opinion, and, one day, like we had yesterday, the Dow being down 200 points was just the first indication, and, it doesn't mean anything other than that.
Right. Well, Larry, thank you for everything you do. You've really slowed us down and had us, looking at larger time frames and really given us an education on these patterns. And to that, we just want to say thank you. You really have slowed us
Thanks for the kind words, but remember, these are only probabilities. They're never certainties.
I understand.
Even though,
you do a good job. You do a good job at reminding us of that too, which we appreciate.
I'm glad one person appreciates it. Thank you very much, Mike.
Oh, we do.
It means a lot. Yeah.
Thank you.
Okay. Thanks for calling in. Okay, we want to get back to the gold market here because we have we made a potential bullish Gartley pattern in the XAU, and the gold has hit some small support down here at this 1660 level. I would like to see gold to get down to about the 1627 level if we were able to get there, but the gold is not out of the woods yet. The overall picture for both gold and silver still look bearish to me, because we bounced off that 618 level last week and dropped over $100 an ounce in gold, and $3.50 in the actually $4.50 in the silver, and so that's really what we're what we're looking at. So if we could get the gold down to 1627, it would look a little bit better than where we are right now. We're in this really tight triangle. We could go either direction from here. So that's really what we're watching here. With that particular commodity is, and both gold and silver, they're both doing exactly the same thing, and so that's why we want to watch them so very closely. But I think the thing that means the most to most of the people listening is the fact that where we are. With the stock market right now, we had our first 200-point down move in the Dow, which was what we were expecting, to at least trigger that these patterns had finally come in. Now, the important part here, and I know most of you folks don't follow, what happens, across the, the globe, but, the reactions that we had in the foreign markets were far greater than what we had here in the United States. The Hang Seng Index had dropped well over 4.5%. The German DAX dropped almost 4%. The FTSE was down more than 3% in these few days, and we were only down the one day. And you listen to the people on TV, they don't have any fear at all, and yet the VIX index looks like it's getting ready. Had a huge move yesterday. And we'll see if that happens. I had a comment by someone, because my trade of the week this week, when the newsletter went out this Monday, was for informed speculators, is to look at the buy the VIX index, with a stop below those previous lows that we made last week, and of course it had the big move coming, and someone said, well, why didn't you bring this up on the show on Monday? Well, first of all, the VIX index is not for most people to trade, and I didn't want to get people thinking that it's real easy to trade, because it isn't. It's very volatile and has a high contract value, but for people that have the ability to take the risk, that it certainly is a good way of when you do get it right, that it works relatively well. But that's a function of how much you want to risk, and frankly, I'm more interested in not losing than I am in trying to hit a home run, and that's really my goal here is to keep you from, getting hurt, and that's the main thing that we try to do, and that's what you try to do, is to get a an idea of where things are really going, and hop on board and see if you can do it. This is what we're trying to do in the Treasury bonds, and we still have a chance. I'm going to be talking about the bonds here for a little bit, because we have we got up to that 143 level today. In the March bonds, we've backed off a little bit from there, but they're in a nice congestion range, and all we need is a little bit of flight to quality, safe haven baloney that they give us, and we could get up into that new high ground level, which rates would be going into new low ground, and that's what we would be looking at. And frankly, if they're willing to pay 2% for 2-year notes in Italy, I can't imagine why our rates are pretty even lower than that. So it's really amazing. Now, should the market, the stock market today, give back everything that it lost yesterday, take it back. In other words, if the Dow would close up, and make new highs, into that, be up about 200, 250 points today, that would make the bears very, very nervous. And you're talking to a bear. I'm always nervous anyway, being bearish or bullish, doesn't make any difference. But if it did that it takes a lot of power for it to do that. And if it were to do it with big volume, that's going to bring a lot of people. It's going to make a headline coming across Times Square, that something really big happened. But until that happens, you have to assume that the market gapping down like it did, and the worldwide basis of what happened to everything, you have to pay attention to the bearishness is out there. And if it does, continue, then you'll be looking at, substantially lower prices in stocks, over the next few months. And I'm not just talking about a small 5% correction like they talk about on CNBC and on Bloomberg. I'm talking about something, really, really serious. And, we'll take a look at, if that does happen down the road. But right now, this is what it looks like. The fact that the first day didn't mean very much, and that's what I look at. I'm just telling you from what I see after looking at charts for many years that all of these patterns have completed, and we did get the first gap down, and we will see what happens over the next few days. The next few days are very key, because if we don't fill that gap in, then we're looking at some things that will look like it's going to go a lot lower. So we'll see if this is the case. The TBT, we're still looking at that $16.80 level in the TBT for our long-term buy. Right now we're trading at the $18.90 level, and when we get there, I'm sure it's going to be real difficult for people to really come in and try to buy the thing, because it's going to be very, very scary. The whole world is going to tell you that interest rates are going to go down forever, and whether that's going to be the case or not, I'm not sure. All I know is that there's a beautiful pattern down there, and there's all kinds of things that tell us that this is where it wants to go. The TBT has been in this long-term congestion level since December now, and I would, like I say, if it can go into new low ground one more time on some type of flight to quality, then this is where I would be looking for it to, really have a spot where we could, really get into it and look at it. I'll also be looking at the bonds, and I'm doing that. Since we're talking about the TBT here, I watch the bond puts, and because, the bonds are a huge market. It's much bigger than the stock market, and the puts that they have, somebody is willing to buy puts up here. You would think that because bonds have been going in an uptrend, that the put premium would be, decreasing, and it's not. So that's telling us that somebody's, willing to step in and buy puts. So, whether that's the professional or not, I don't know. All I know is that the small time trader is usually not in the, large volume of the put and call market. So, we'll have to, see what happens. Now, I've also checked with the, what happened with the gold open interest and the open interest in the silver during this past break. And, it's not been good as far as from the bullish point. It has a bearish tone to it. We've had people, leave the market, and the volume has, on that big down day we had increased volume, but the open interest, didn't do anything. So there was no new buying coming in, and there was no new selling coming in. So it was just the normal people, trading the market, and so there was nothing that really tipped off that, we're getting ready to go. The volume on the downside in the gold and the silver was substantial that day. A lot of it is margin call related, and that has dissipated, and the market has bounced off of that that first spot that it should have. And we talked about silver, going down to that $33 per barrel per ounce level, and it's interesting that we hit very, very close to that, and is held up relatively well, at least so far. So the bullish Gartley that we have potentially forming in the XAU is interesting. We have that same thing occurring with the gold bug index. It also could be forming a Gartley pattern, and if it can hold this level, we have a real chance that maybe gold could finally get out of its own way here. But we've been in a downtrend with these gold bug index for quite some time, and we really need to hold where we were yesterday with the gold and silver in order to keep this market to be bullish on the upside. Because if you get a chance to go into Tiger TV, you'll see that the gold-silver index stopped right at the 786 retracement, just like we did with the XAU stopping at the 61% retracement. And so we have a chance that this, in fact, could be a spot where we're getting ready to, have a rally from here. But it's got to get going. It just can't just hang here for very long. We're in a spot where we have very little time left from the bullish side of this, because these lower lows and lower highs are ominous, to the long side of these things. So this is why we want to, keep an eye on, where we are with the gold and silver. Okay, now the next one we really need to talk about is related to, crude oil, because crude oil has been in this really pretty volatile range between 110 and this 105 level, and we mentioned 105 several times as being the first level of support, because that's where the market broke out of. If you remember, we said once it closed above that 104 level, that that take the prices at least to the 112. We got to 110. And we're back, we came back and, made the, test just the other day, yesterday in the in the crude oil. And so we want to keep an eye if this is going to, do this. It's the difficulty of doing this show when you have a 9-month-old grandson sitting in your lap is really difficult. The fact that he's not making a lot of noise is really surprising, but I don't know if he's just overwhelmed with all my things that I'm saying, or he's just saying, just biding his time to say something. But so far he's been a good boy, and God willing, he'll be quiet for just a tiny bit longer. Okay, I had a question from someone about the oil market, and we're going to take a little break here, and when we get back, we'll finish up with the oil market and get ready to tell you what I'm going to be doing on the commodity show for tomorrow.
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, just want to let you know I did give you some jewelry. My jeweler offered me about $650, but you get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, good.
I'm very happy.
Well, I appreciate it. Now, Did you sell us jewelry, or did you buy coins off us?
Yeah, I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume and the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at tfnn.com.
Okay, we're back, folks. And the one thing I want to keep in mind here that, Apple is not the stock market. The NASDAQ is, 20% weighted in Apple. So don't be concerned about what happens to Apple today. It's going to go up forever. So it's not, not important whether it's going to be, 550, 600, whatever it happens to be. It'll affect the stock market with the NASDAQ, but that's not the overall market. Keep an eye on what that NASDAQ is doing. What the New York Stock Exchange index is doing, and not the NASDAQ. I believe that we're going to have a little problem with Apple up into that 550 level, but that's just a technical thing that I'm looking at. Now, we want to get back to crude oil because, we have came back, better than $6 a barrel in crude after making the high up at 110. We didn't back off at all compared to what happened with gold and silver. Crude is still in a pretty strong uptrend, based on the daily and the weeklies. I still think we got a shot at, 122 in the crude oil if we can clear 110, and that would be the 786 retracement, of the long move, that we have. I've only got a few minutes left here, and I wanted to emphasize what I think is the most important thing that we have going for us, coming into the tomorrow's trading and the next day's trading, is this gap that we had in the New York Stock Exchange Index and the fact that we've held this level. Today we have not fallen completely out of bed. Now, this could be a one-day phenomenon that we're just going to get a little bit of a down move like we got yesterday, and then it's off to the races. This would mean that all these cycles that have happened across the global basis, all of these are going to, break out to the upside. I'm not sure that that's going to happen. All I'm saying is that the bearishness is out there, and we really need to, focus on the fact that if this is bearish, you don't want to, try to buy the dips, because the dips are going to be, pretty substantial. And I've said, since way back when, back in November, I believe, when we had that major bottom down there on the weekend of Thanksgiving, that, we had all these, days where we were doing moves of 400 points in the Dow. We had quite a few of those, and I think that when we do get the expansions of these things starting to occur, they're going to be 1.618 of that, and that means we will see some days where the Dow moves 700 points, and usually, because greed is a less emotion than fear, fear being the greater emotion, that the fear cycle will be stronger to the downside, so the 1.618 would take place, at the 700 level, and that's, really what we're looking at as far as what we want to see when the market gets ready to turn down. One day does not mean very much. Where we are right now, the market has done, virtually, very little. We've had just a little bit of a bounce. There's going to be some resistance up in the S&P, I believe, around at 1355 basis the March futures. And, we'll just have to, see if that, in fact, does anything, to hold the market. But the gap in the New York Stock Exchange Index exists starting at around 8,000. Right now we're at, 79, 76 and change, and so, nothing really dramatic has happened yet. We just had one really big, strong down day. It was across the board globally, and so what we need to do is to see what happens over the next few days, because if we come down here hard, this is telling us that this cycle that we've been talking, or at least I've been talking about, is there, and I'm as bearish as I have been since last May and July of a year ago. So this is a time when you don't want to be too bullish, at least based on my opinion. Anyway, we're ending up the show. Have the Commodity Show tomorrow. Thanks for listening in, and all the best to everyone.